Imagine waking every morning, working harder than ever, yet watching wealth quietly move further beyond reach each passing year. The economy looks strong on paper, markets climb higher, yet many workers feel strangely stuck despite progress. Something fundamental has shifted beneath modern capitalism, and most people notice only the symptoms appearing today. Salaries still matter greatly, promotions still matter, careers still matter, but ownership increasingly matters much more. Today, the biggest economic divide isn't simply between rich and poor people anymore across society. It's becoming the divide between people who own assets and those selling labor for income. That distinction sounds technical until you begin seeing its effects throughout everyday life and finances. Two neighbors can earn nearly identical incomes and work equally hard throughout their entire careers. Yet 10 years later, one may build substantial wealth while the other struggles financially daily. Their effort was similar, their intelligence was similar, their discipline was remarkably similar throughout life. The difference wasn't talent, luck, education, or ambition alone. It was ownership itself entirely. One owned assets steadily increasing in value while generating wealth automatically over many years. The other relied almost entirely upon wages earned through labor and personal effort alone. That gap is becoming one of the defining stories shaping the modern economy today. Understanding this shift may explain why prosperity feels increasingly uneven despite economic growth everywhere. For much of the 20th century, labor remained the primary engine of upward mobility nationwide. People exchanged skills, effort, and time for steadily improving living standards across generations consistently. Factories expanded rapidly, businesses grew larger, and workers often shared those gains directly afterward. Wages generally rose alongside productivity growth for several decades throughout developed economies worldwide together. The arrangement wasn't perfect, but it felt relatively balanced and predictable for families everywhere. If workers produced more value, they usually earned more money through higher wages afterward. Entire middle classes emerged from this economic relationship and expanded across society successfully afterward. Families purchased homes, raised children, and built financial security primarily through stable employment opportunities. A dependable job often provided a clear path toward greater prosperity and economic stability. That expectation became deeply embedded within society and shaped long-term financial decisions everywhere. Parents expected their children would achieve even greater prosperity than previous generations experienced before. Schools prepared students for careers promising stability, advancement, and long-term financial independence afterward consistently. Politicians built campaigns around expanding employment opportunities and strengthening pathways toward economic success. Hard work became more than an economic strategy for achieving personal financial improvement consistently. It became a cultural belief deeply connected to opportunity, fairness, and future prosperity everywhere. Then something started changing quietly beneath the surface of economic growth and prosperity narratives. Not suddenly, not dramatically, but steadily enough to reshape expectations across entire generations gradually. Houses became harder to afford despite growing experience, education, and years spent working diligently. Rent consumed larger portions of household income year after year across cities nationwide today. Stock markets climbed toward record levels while wages moved significantly slower for workers overall. Workers felt busier than ever, yet wealth seemed increasingly difficult accumulating over time consistently. Many blamed inflation, globalization, corporations, technology, or government policies for these emerging challenges. Each explanation contained elements of truth, yet none fully explained the entire transformation occurring. A deeper force connected these trends together beneath the visible economic headlines and debates. That force was the growing dominance of assets over labor throughout the economy today. To understand this shift, we need to understand two surprisingly simple economic concepts first. Labor generates income through work, effort, skills, experience, and personal productivity over time. Assets generate income through ownership and often continue creating value automatically over time. Labor requires continuous participation because income usually stops when work activity stops completely. Assets often continue generating value even when owners aren't actively involved every day. A software engineer earns money primarily by writing code and solving technical problems. A landlord earns income primarily through property ownership and collecting rental payments regularly. An investor earns returns through stock ownership and appreciation within financial markets consistently. A business owner earns income through ownership of productive systems and operations globally. The distinction appears simple initially, but its consequences become enormous over longer periods. Every worker faces exactly the same biological limitation regardless of profession or income level. There are only 24 hours available each day, and everyone shares that constraint. Nobody can negotiate additional time regardless of ambition, intelligence, or financial resources available. Nobody can manufacture extra hours despite technological advances or increasing workplace efficiency gains. Labor income remains tied directly to this unavoidable limitation throughout a person's working life. Workers can improve skills, efficiency, productivity, and expertise to increase earning potential significantly. Yet, eventually limits appear because time itself remains permanently restricted for everyone equally. Assets operate differently because ownership isn't constrained by individual human biological limitations directly. A single investor can own thousands of productive assets spread across global markets simultaneously. A shareholder can benefit from millions of workers operating across multiple countries every day. A landlord can collect rent from several properties without personally managing every activity. A business owner can serve customers worldwide through scalable systems operating continuously today. Assets scale efficiently because ownership can expand beyond individual human capacity limitations dramatically. Labor generally cannot scale similarly because it remains tied to personal time directly. This difference became increasingly important as technology transformed nearly every major industry globally. During earlier industrial periods, companies usually needed larger workforces whenever expanding production significantly. More growth typically required hiring additional employees to support expanding business operations successfully. More employees generally meant higher wages flowing into communities and local economies afterward. Growth and labor remained closely connected through much of modern economic history previously. Technology gradually changed that relationship by reducing dependence upon additional labor for growth. Software allowed companies to reach millions of customers with remarkable efficiency and speed. Digital platforms expanded globally while employing relatively small teams compared with historical businesses. Automation increased productivity dramatically across manufacturing, logistics, finance, and many other industries. Companies generated greater output without proportionally increasing labor costs or workforce sizes significantly. Productivity soared rapidly, creating extraordinary gains in efficiency across the economy overall. Profits expanded substantially as businesses captured more value from technological improvements consistently afterward. Financial markets celebrated these developments because efficiency improvements boosted expected future earnings significantly. Yet workers often captured smaller portions of productivity gains generated by technological advancement. The value created didn't disappear, it simply moved toward different economic participants instead. Increasingly, that value flowed toward ownership rather than employment relationships across industries globally. Shareholders benefited directly from rising corporate profits generated through expanding productivity improvements everywhere. Investors benefited from increasing valuations as financial markets rewarded scalable business models heavily afterward. Asset holders accumulated wealth faster than wage earners relying solely upon labor income. The economy continued growing steadily, while wealth creation increasingly favored ownership structures over labor. Economic growth remained strong, but wealth creation increasingly favored ownership structures over labor. The distribution of rewards changed significantly even while overall prosperity continued expanding nationally. Then, another powerful force arrived and accelerated these trends dramatically across markets worldwide. That force was interest rates and the policies surrounding modern financial systems today. Following crises and slowdowns, central banks reduced borrowing costs to stimulate economic activity. Cheap money encouraged investment throughout financial markets and broader economic systems everywhere simultaneously. Investors borrowed more capital because financing costs remained historically low for extended periods. Corporations borrowed aggressively to expand operations, repurchase shares, and pursue growth opportunities. Governments borrowed extensively to support economies and maintain spending during uncertain periods. Asset purchases increased rapidly as capital searched continuously for higher returns globally. Rising demand pushed asset prices higher across stocks, housing, and investment markets broadly. Stocks appreciated substantially, generating enormous gains for investors already holding diversified portfolios. Real estate appreciated steadily, increasing wealth for property owners across many regions globally. Private businesses appreciated significantly as investors valued future earnings more aggressively afterward, consistently. Existing owners became wealthier largely because they already owned appreciating productive assets beforehand. If ownership keeps winning while labor falls behind, can work alone still guarantee prosperity?